Anyways, so this Bloomberg article does talk about the big dogs or big players or big guys, whatever you want to call them. These titans is what Bloomberg calls them. Private credit titans. They are grabbing more than half of new deals. They are saying that about 58% of the total capital deployed by private credit managers globally is estimated to come from firms that lend more than $10 billion a year, according to a recent ACC report released last Thursday. And this, again, implication is that they're crowding out the little guys. And sure, these big chunks are going to be gobbled up by the bigger entities, but that 42% is nothing to sneeze at. And this is what I was kind of discussing this before, and I alluded to it, is that I think these bigger companies are probably set up to take down big deals, but not small deals. It's like, maybe picture like a giant. Yeah, they're great at scooping up entire, eating cows and big things, but they can't get a little tiny thing. They can't pick up a drumstick. Well, that's for me. I'll eat that. That's my dinner. Sometimes you can be too big to grab some of these opportunities. And I think that it does bear a little bit of a logical similarity to this $10 billion company that may lack the capacity to analyze and pursue $1 million deals.
Well, yeah, it's not worth the time. It's the same reason why we don't pursue small acquisitions. Mm-hmm. It takes us basically the same amount of time to close a small deal than a big deal.
Yeah.
And so if you've got limited amount of resources, just not efficient to do small deals. But
if it's a one-man shop to pursue like a little quadplex, that's great.
Yeah, exactly. All day long, and you can find a really good niche in doing that. Mm-hmm. A lot of that. I mean, that's where on the preferred equity side. I mean, that's where we have a niche at Great Capital is writing checks kind of between $1 million and $5 million because there isn't really anyone else in that space doing. There's very few other participants in this space. Everyone wants to write a $10 million check or a $20 million check.
Yeah.
Matt, can you just mark real quick, 4530?
Mm-hmm. So, these bigger players in the private lending space, they've got people ready to invest with them. And as this article also says that they're able to marshal more cash for individual deals. But I do think that there is room again for like these smaller problems that they don't have unless they're running like a perfect symphony and intricate system, which they're not.
Yeah.
I don't think that they just have the capacity to get these, maybe 1 million or 5 million or just a smaller deals. And even the examples that they pull, which are really useful, and I want to talk about in a second, the lowest dollar value is like $75 million. So, but this, and this is really interesting, and why I mentioned before that these interest rate pressures and the loan, like the lending strictness that we're seeing, that we've seen in the past 2 years, it's not just in the CRE market. It's way more than mortgages. Yep. One of these deals is a loan for a take private of an online classifieds company. There's one about a loan for an energy company, one for compliance management software solutions, and then a few more about like acquisitions and stuff. I think some of these are just for operations, some are acquisitions, some there are lots of different reasons why people are needing money. And this is what Blackstone and Ares are stepping up to provide this capital to keep commerce flowing. If this is an adjustment period, if the CRE market is heading for asset valuation reduction, I wonder, is a similar thing happening? And when it comes to companies and the kind of corporate world,
it's a good question. I think in some ways it's already, looking at the tech industry, it kind of happened last year, and then they're kind of recovering, but that's much more forward looking. And we're also looking at the stock market, which is, forward looking. No, but I think most of the economy is facing, similar pressure. I mean, most businesses, are generally not financed the same, but are, in a very similar kind of credit environment, and environment where credit is tighter, the same issues are showing up.
Yeah.
And investor preferences are also been moving around and looking for yields, but also there's more competition from treasuries and the like. So some of those yields on the private credit side also have to go up as well. And so those returns are starting to look attractive, especially in an environment where equity returns they've been good this year, but I think, there's uncertainty in the economy, recession. And so if you can get, double-digit returns from investing in corporate credit, those are kind of equity-like returns. And so, but with a lot more safety typically. So it makes sense to investors. Again, it's one of the reasons why we're looking at we're doing preferred equity deals right now is because, they've got, they feature returns that are very similar to equity-like returns, but with a much more attractive risk profile given this current environment.